My name is Bob Cunningham, and I'm the incoming managing partner. Greg Marco, where are you, Greg? Wave. Greg has been our fearless leader and done a wonderful job, and he will be retiring later in the year, but we sure thank him for all of his efforts. The Tax Cuts and Jobs Act of 2017 is the most significant tax act in over 30 years. Many of you were very young 30 years ago, but I think I've been working 8 years. And what was going on in 1986? That was called the Tax Reform Act of 1986. If you recall, Ronald Reagan was president. That tax act, while it had some really good provisions, it had some negative ones that were pretty severe as well. It cut the tax rates substantially for a lot of different higher income individuals. Likewise, the state and gift tax exclusion amount was $600,000 at that time, so you can see we've changed a lot since then. The negative thing that happened in the Tax Act of 1986 was related to depreciation. A lot of people were not able to deduct depreciation because of the passive activity laws that came into effect. And that took the real estate industry several years to recover as a result of that. As you can see, there have been a lot of changes through the years as far as smaller tax acts that have taken place, such as that $600,000 grew to $5 million, and now it's changed again, obviously, in the new tax act. So basically, the changes are substantial and they're far-reaching, and they have an effect on virtually every U.S. business, their owners, their employees, and all the taxpayers, including all of you here in this room today. So what we want to do is just give you a general overview, and we'll get into some of the areas that we feel like are most interesting for your behalf. Some of the areas you may not be interested in, but I think it'll give you a good feel for what's in the law. We're going to have 4 of our partners speak today. Stephanie Smith is going to start off, then Melanie Woodrick, Mike Carraway, and then John McCallum will wrap us up. Stephanie is a firm leader in litigation support and fraud and forensics and has a heavy tax practice.
The new Tax Act is both positive and negative. It's simple and it's complex. And today, in thinking about it, I want to spend a minute talking about how we calculate your individual income tax. In its most simple formula, we take your adjusted gross income, we reduce it by your standard deduction or your itemized deductions, whichever one is greater. We reduce it by your personal exemptions, which is an amount you get for every dependent in your household, and we get your taxable income. And to that number, we apply your tax rate. One of the first provisions of the new tax bill that we're going to talk about affects everyone in this room, and that's that we have new rates and brackets. The highest individual rate dropped from 39.6% to 37%. We still have 7 brackets, and they go from obviously 0 to 37. So most individuals will end up paying tax at a lower marginal rate. Sounds like a good thing. The second thing that you need to know is that the standard deduction has almost been doubled. For 2017, if you took the standard deduction and you were a single person, that was $6,350. For 2018, the standard deduction doubles. Almost doubles. $12,000 for a single person, $24,000 for a married couple filing jointly. Now, you can still itemize your deductions if they're higher than the standard deduction, but for many people, the standard deduction may be high enough that it exceeds their itemized deductions, and we may have fewer itemizers out there. You also will still get additional standard deduction for being 65 or older or being blind, and those numbers do not change. So this part of the new act sounds simple, sounds like simplification. The final thing that's going to affect everybody is that the the personal exemptions have been eliminated. So instead of getting to deduct $4,050 for every dependent in your household, you will no longer have this exemption, this deduction at all. It's gone away. This is a real negative thing for larger families in particular. Now, the personal exemptions did phase out for higher income taxpayers, and so that was not necessarily a benefit for everyone, but most middle income taxpayers really appreciated and took advantage of that personal exemption deduction. So those three things are going to affect everyone in this room. Now there are some more provisions that are going to affect individuals, but maybe not everyone. The first one has to do with capital gains. A capital gain is when an individual sells an asset that he's held, such as stock or properties. Capital gains have traditionally had preferential tax rates. They're either taxed at 0, 15, or 20%. And the tax rate that your capital gain has is based on your individual tax rate. And so with the new rates coming into effect, those capital gain brackets had to be moved a little to fit the new rates, but the treatment is still the same. We'll still have 0, 15, and 20% tax rates for capital gains. Another thing that will affect many individuals is the alternative minimum tax. The alternative minimum tax is a calculation that's separate from your regular tax, and it was designed to keep taxpayers with high incomes from avoiding tax because they had large deductions or exclusions or credits. And to calculate that, you would take your regular income and you would add back some things that weren't deductible for alternative minimum tax purposes. You got an exemption amount or an exclusion amount, and then you came up with a tax. If the tax was higher than your regular tax, you had to pay the higher tax. Now, the exclusion amount was roughly $84,000, but it phased out when your income hit $160,000. So a lot of people that weren't really high income taxpayers got caught in this alternative minimum tax trap because this exclusion phased out at $160,000. The new law has raised that exclusion to $109,000, and it doesn't phase out until we hit $1 million. So I believe we're going to see a lot fewer individuals subject to the alternative minimum tax, which is a good thing. Another thing that will affect individual taxpayers is the repeal of the Affordable Care Act individual mandate. Now, with the Affordable Care Act, we got something called the shared responsibility payment. It's really a penalty. It's assessed on individuals that didn't have a minimum essential health care coverage. This penalty was assessed per individual per month that you did not provide minimum essential coverage for someone in your family. This penalty was paid at the time of your tax filing, and beginning in 2019, so we've got 17 and 18 to go, but beginning in 19, that is repealed forever. It will go away. We will no longer have the individual mandate for health coverage. Interestingly enough, the Congressional Budget Office has said that this one provision may raise $300 billion over 10 years. Because when individuals aren't forced to seek subsidized health insurance coverage, they probably won't. So that's a provision that will generate some revenue and relieve some bookkeeping nightmares for human resource people. There was a rule in place that allowed you to recharacterize your IRA contribution. If you made a traditional IRA contribution and then decided you'd rather have a Roth, you could switch it. If you had a Roth and you wanted to convert it to a traditional, you could do that. Well, that has changed now, and you can no longer unwind your Roth IRA. If you have a Roth, you can no longer turn it back into a traditional IRA. That is only useful for some specific situations, but it is a change. the estate gift tax exemption amount increased. Gift taxes or estate taxes are paid on certain lifetime gifts or certain gifts or transfers at death. That exclusion, Bob mentioned earlier, has been around $5 million per individual. And beginning in 2018, that number is going to be doubled almost to 11.2 million for a single person or 22 million for a married couple. So that's a significant increase in the estate tax deduction. And finally, I'm going to end on a good point. We have expanded use of 529 accounts. Now, a 529 account is a college savings plan. It is deductible for state tax purposes, but the money grows tax-free, and as long as it's used for higher education expenses, it is not taxed. In higher education expenses have, of course, been defined as college tuition, reasonable room and board, books and supplies, and equipment necessary for college education. Now, under the new act, higher education expenses are now defined as also including elementary and secondary, private, religious, or public schools. So you can take up to $10,000 a year out of a 529 plan to pay for private school tuition. This is going to really cause us to put some thought into how parents and grandparents do gifting or establish education funding, because it's a great, it could be a great tool for people, especially in our area where we have a high use of private schools. This is a good thing. Now I'm going to turn this over to Melanie. Melanie is going to talk about some deductions and credits that the new act has brought us. Melanie is one of our tax partners. She works with real estate and business transactions, and she is also our firm's Lean Six business consultant.
Thank you, Stephanie. I'll do my best to make my points concise and try to make it interesting but not be too lengthy. Woodrow Wilson was once asked how long it took him to prepare for a 10-minute speech. He said, that takes about 2 weeks. They said, really? How much for a 1-hour speech? And he said, that takes about a week. They said, well, how long does it take for a 2-hour speech? He goes, oh, I'm ready now. So I'm ready now. If y'all are ready, I got 2 hours, I can condense it. So the information I have is a mixed bag. As Stephanie's mentioned, Congress gave us some good things like reduced tax rates and increased standard deductions, but with the other hand, they took back some really popular deductions, and so I get the pleasure of sharing that good news with you today. Before I start, I want to let you know that most everything I'm talking about has some provisions, time provisions. So most of these provisions start in 2018 and end in 2025. So this is going to be the world we live in for the next 8 years. But that doesn't mean it's permanent. Congress can make changes after this, or they could jump in the middle and change it. So we're operating under the framework that if I don't say so, these are the next rules for the next 8 years. The first area I want to talk about is the state and local income tax deduction. If you itemize, you know that you can deduct a lot of different kind of taxes on your personal return. We're just talking about personal deductions here, so that's real estate taxes, which can be on your home, you might own some land, you might have a second residence. Real estate taxes, you can also deduct personal property taxes, which are your car tags or trailer tags, those kind of things. You can also deduct your income taxes, which is, of course, what you pay in your estimates, or it could be your withholding that you have on your W-2. So you add all those up and you've got state income taxes, you've got real estate taxes, you've got personal property taxes, and in some cases you can deduct your sales taxes if those are less than your income taxes. Now when you add all those up, it's a pretty big pot. Well, the new law says we're going to add them all together and all you can take is $10,000. So when you add all of those things together, all we're going to give you is $10,000. So that's going to be for many people a reduction in the amount of their deduction for income taxes. So in the future, the timing of those is going to be really important to make sure you take advantage of any benefits you have in that area. The next area that has a wide-ranging impact is the mortgage interest deduction. Prior to 2018, you could deduct mortgage interest on home acquisition debt of up to $1 million. So if you had a mortgage of $1 million, all of the interest would be deductible. Now you could that was $500,000 then for married filing separately. Also, under the pre-18 rules, you could have a home equity loan of $100,000. Now that could be used for home improvements or to buy a car, to go on vacation. There was no stipulation of how that had to be used. It just counted toward that $1 million limit. Now the new rules are tighter. So for 2018 and later, new acquisition debt is limited to $750,000 for married filing jointly. And that's $375,000 for married filing separately or single. So think about that. That's $375,000 is not a huge amount of mortgage debt. And so that's the limit going forward. If you already have a large debt that's within that $1 million, you're grandfathered in, so you don't lose anything, but any new debt you incur will be subject to those new limits. Now the really bad news is that you can no longer deduct home equity interest at all. So many of us will need to rethink how we're using those and whether we want to pay them off and use something else to finance some opportunities. Charitable contributions. Prior to 2018, the tax rules limited your deduction based on your contribution base times a percentage depending on what type of charity you have. So your contribution base was your adjusted gross income before any net operating loss, and then you multiply that times either 50, 30, or 20, depending on the type of charity. So for example, if your AGI was $100,000 and you wanted to make a $60,000 one-time contribution, your limit would have been $50,000 in 1 year if it was a public charity. That extra $10,000 would carry over and it could be used in the next 5 years, but you would be limited to 50. The new rules have increased that 50% bracket to 60. So in that scenario, you would be able to deduct the full amount in 1 year, if up to 60%, and the carryovers are still 5 years. Now there's another limit on contributions. Many of us make contributions to our favorite athletic foundation so that we can get some good seats for the football games. And the IRS has been pretty generous with that. A few years ago they said, look, if you make a $10,000 contribution and you're getting some preference on seating or a right to get seats, then we're going to treat 20% of that as non-deductible and 80% as deductible. So if you gave a $10,000 contribution to your favorite foundation and you got the right to buy tickets, you would get an $8,000 deduction. Well, Congress has decided they don't want to support that. So now contributions where you obtain rights to buy seats are non-deductible in total. That's not good news for a lot of us. Moving expenses. Prior to 2018, if you moved and your moving expenses qualified, you could deduct those on your tax return. Also, if you were an employer and you wanted to reimburse your employee for qualified moving expenses, it was not taxable to the employee, or you could pay the moving expenses and that wouldn't be taxable. Well, Congress decided they didn't want to support that either, so no more moving expenses deduction, and now if an employer reimburses an employee, the employee will have to pick that up in taxable income. So that will have to go on their W-2 wages from this point forward. The only exclusion for that is for armed forces personnel if they're moved according to military orders. So the only thing for sure are death and taxes. And in the case of student loan debt, even death didn't make it go away. So before this year, if you died and you owed student loan debt, you had to pick it up in income. So Congress decided that was going a little too far, so they decided that if you died and your student loan debt went unpaid, that's not going to be taxable anymore. I know you'll be glad to hear that. And also, if you become disabled, it will no longer be taxable either. So, there may be a few people that can take advantage of that, although I hope nobody's hoping to. The student loan interest deduction was not changed. Now, the living expenses for Congress, the new Tax Cuts and Jobs Act prohibits members of Congress from deducting their living expenses while they're living in D.C. and working in their at Congress. Now, I know this doesn't affect anybody in here, but I'm pretty glad they finally got something taken away from them too. So I just threw that in there because it makes us feel better. All right, the tax child credit. This is considered really one of the most family-friendly and middle-class friendly provisions. Up until now, if you had a child under the age of 16, you may be eligible for a $1,000 per child credit. Now that credit went away at very low income levels, so many people did not qualify. Under the new rules, you get double that, you get $2,000 per child credit, and you get to take it all the way up to an income of $400,000. So many more people will be able to claim that. I think this was done to kind of offset the exemption loss that Stephanie mentioned. In addition, they added some partial credit of $500, and this is for dependents that aren't necessarily children. So the child credit is for people who are children who are under 16. Well, the partial $500 credit applies to children that are over 16 and under 19, which many of us have those, or if you have a student, a full-time student who's age 24 or under, you get the partial $500 credit. And you can also get it for parents now. If you have dependent parents, they may also be eligible. So they've loosened those and given us a little bit of partial credit there. Alimony. This change is one that I don't really know what the reasoning was. It must have been somebody who was planning a divorce is my thought. But traditionally, alimony payments get to be deducted by the person that paid them, and their taxable income by the person that receives them. Well, Congress decided we're not going to even care about alimony payments. So starting after 19, this is one of those that's not this year, but starting next year, for divorce decrees or separation agreements in effect after 18, you will no longer have an alimony deduction or income reported. So this will be a planning opportunity for some of us. Hopefully nobody in this room. Okay, this is another one where Congress took some things away. Miscellaneous itemized deductions. Many of you have been able to deduct these items. They were 2%. If these expenses exceeded 2% of your adjusted gross income, you could take some miscellaneous deductions. If you made $100,000, 2% is $2,000. So if you had some miscellaneous deductions over $2,000, you get benefit for this. Now, what are those? Those are things like employee business expenses. If you drive your car for work, you might take mileage, or you might take your actual expenses. You might have union dues, you might have out-of-pocket costs, you might have meals and that aren't being reimbursed by your employer. You might also have IRA trustee fees, many of us, investment fees from your broker, safe deposit box rental, legal fees for tax advice, tax planning and tax prep fees, and then also some hobby loss expenses. Under the new Tax Act, there are no more miscellaneous deductions. So that will hurt a lot of employees who depend on that. There may be some planning opportunities here, though, for employers. So, be sure and check with your tax advisor to see if there's some ways that we can mitigate this. I'll now turn it over to Mike Carraway. Mike is a tax partner who specializes in mergers and acquisitions, as well as entity selection. Mike will give you an overview of the business provisions. Thank you.
So imagine you are playing Monopoly. You've got Park Place and Boardwalk, okay? you were going in for the kill. Your opponent, the one you were wanting to take out of the game first, they got Baltic Avenue and a railroad. They got nothing. Okay, you're going after them. You're ready to go in. You've got the rule book next to you. Real quick aside, I'm trying to settle a dispute I'm having with my sons at home. Free parking. What happens? I get to ask you guys questions. What happens when you land on free parking? Okay, you get the money that's in the middle, right? Everybody plays that way. You know that's actually not in the rules. According to the rules, you get nothing. Free parking is nothing. Nothing happens. But where'd that come from? Who was the first person that said, "Hey, let's throw $50 in the middle and put the tag"? That's not an actual rule. That has absolutely nothing to do with what I'm talking about. But I argue with my kids about that all the time. So you're in the middle of the game. Again, you're doing really well. You got the rules there next to you. You have to refer to them every once in a while. You ignore them in terms of free parking. We all do. The Parker Brothers executives walk into the room. May we have the rule book, please? They take the rule book from you. Or change some things, okay, that. They hand it back to you. They've changed the rules, and it's the middle of the game. Now, all of a sudden, houses are going to cost 110% of what they cost before. Hotels are going to cost 75% of what they cost before. And railroads are going to get double the rent they got. Do not try to draw parallels between this and tax law changes. There are no direct parallels. I'm painting a picture. And when you pass go, you don't get $200 anymore, or some of you do. But if you're somebody tell me because we all have our favorite little playing pieces, right? Play Monopoly. Favorite piece. Who are you always when you play Monopoly? Anybody? Top hat. Okay, you're the top hat, and when you pass go, you get $225. What about, okay, let's use the thimble. Nobody wants to be the thimble, right? Is anybody here, you're not going to admit to it if you're the thimble. Let's say if you're the thimble, you get $250, okay? Everybody else still gets $200. This is going to change how you look at the game, right? Okay, thank you. We're talking about a game of chance. Obviously, this is a very poor parallel for business and life. But if that changes the way that you look at Monopoly, think about how the changes to the tax provisions that apply to businesses getting changed in the middle of the game, because we're all in the middle of the game. Think about that level of complexity. What does that do to change your strategy, your planning? If a top hat is going to be treated differently than a thimble, if you're the shoe, you may say, I might want to be a thimble or a top hat. How do I do that? That's kind of the world that we're in now. There are certain things that I've been doing this for a number of years, as have a lot of other folks in this room. There are certain things we've taken as truisms. They just are. For our tax purposes, corporations are bad and partnerships are good. Equipment can be traded in tax-free. Net operating losses can be carried backwards and then forwards. There was a certain shape to the things that we did. As of January 1st, that shape is different. I think in terms of pictures and colors and shapes, those shapes and pictures and colors, they're different now, which requires those of us who are in the middle of the game, which is everybody in this room, to pause, reassess, and think, do I still want to be the shoe? Or do I want to be the thimble? And do I really want that property I was after, or do I want to invest in the railroads? So that's what we're talking about, but on a much grander scale than a simple board game. So I want to walk through a few things very quickly that have changed. There's no way we can go through everything, obviously, and there's no way we can fully cover the things that we are going to go through in the time that we have remaining. So, first thing we're going to talk about are the changes to corporate income tax rates. The pre-existing corporate income tax rate structure was not unlike the individual rate structure in that it was a graduated rate structure. Started at 15%, went up to 35%. The 35% applied to taxable earnings of $10 million or more, so we didn't see that a lot, but it was there. Now, there is no graduated rate structure, it's 21%. What that means is, of course, if you were a corporate taxpayer with very low taxable income, maybe $90,000 or less, you're actually going to pay a little bit more in income tax now. But earnings above that, obviously, we're going to see some significant savings. This is a big deal. You may hear me mention this once or twice more. This is one of the centerpieces of the overall goal that something that's been talked about for a number of years, and that is making the U.S. tax system more competitive with global tax systems, to make U.S. businesses more competitive with foreign businesses. Whether you think that's a good thing, whether this has done that or not, I'm not here to grind any particular political axe, but this is one of the main things that was done to purportedly get us there. And you're going to hear me mention that another time or two. So clearly, this is a good thing. If you are a U.S. business that operates as a corporation, if paying less tax sounds like a good thing to you, this is a good thing. If you operate as a C corporation, you basically do nothing, you will pay less in tax in most cases, if all you look at is this. But there are other things in the landscape that are changing. Again, the rules aren't just changing for the thimble, they're also changing for the top hat. And we're going to look at that in a couple of minutes. But a few other things that are changing for corporations that I want to mention very quickly. Almost a housekeeping item that is related to this rate drop, reduction of the dividends received deduction. This deduction existed to somewhat ameliorate triple taxation or even quadruple taxation on a corporation and ultimately its shareholders if a corporation received a dividend from a corporation in which it owned an interest. Previously, this deduction was 70% of the dividend received or 80% depending on the ownership. This has been scaled back to 50% or 65% basically because, well, we're going to charge you less tax, so we're going to give you less of a deduction. That's the only reason they've done that. Another thing, you heard Stephanie talking about AMT before for individuals. Again, this has been discussed for years. We want to kill AMT. AMT is bad. I agree AMT is bad. They were not able to get there for individuals. You heard discuss some pretty significant changes to AMT for individuals, which are good. Again, if we're in the paradigm of less tax good, more tax bad, that's good. They were able to actually kill it for corporations. So this parallel tax that could have a corporation, and often would, have a corporation paying tax even in a year of a loss because of certain add-backs and limitations on the use of the net operating losses for AMT, that's gone. And this is for years, of course, starting in 18. Another thing that has been changed, and it's a bit of a mixed bag here, net operating loss changes. This is not just for corporations, it's for all taxpayers. Again, one of the things that we've taken as a truism is that net operating losses, they can be carried back, they can be carried forward. Well, in the old days, it was 3 years back, 15 years forward. More recently, it's been 2 years back, 20 years forward. As of 18, for losses in years 18 and after, carrybacks are eliminated completely, except in the case of certain losses for certain farming businesses. We won't get into that. There is still a 2-year carryback for them, but for everybody else, there is no more net operating loss carryback, but the carry forward is indefinite. So in the past, we had to basically watch our net operating losses, and as they got older, well, we're getting closer to losing them. You don't lose them anymore. They're indefinite. So that's a good thing, even as the government taketh in saying you can't carry your NOLs back anymore. They giveth and say, well, they never expire anymore. Something else that they took, however, is limitation on how the net operating loss can be used. This is actually similar to the rule that we did have for alternative minimum tax. What this says is you can only use a net operating loss carry forward up to 80% of your taxable income for that year. That means exactly what it sounds like it means. If you've got $1 million of taxable income in year 2, well, in year 1, you had a $1 million net operating loss. You think, well, that's great. They net to zero. I don't owe anything. Nope. You're going to owe tax on $200,000 of taxable income, everything else being equal, because you've got that limit that only lets you use up to 80% of your taxable income. So everything else being equal, you'll always have a liability. But again, the giveth in this situation is that that net operating loss doesn't expire. It continues carrying forward. So that's a few of the changes on corporations, which you think, okay, if we stop there, pretty simple, I got it, thank you, I want to beat the crowd, get out of here, I'm done. Well, we're not done, because now we're going to talk about the thimble. So let's talk about what I've got labeled there as pass-through deduction. That's what we're calling it. It's actually more technically called a qualified business income deduction. This is a deduction, could be up to 20% of the qualifying income that comes through pass-through entities, partnerships, S corporations. Let me mention this. Anytime you hear me say partnership, I'm talking about any legal entity that is being treated as a partnership for federal income tax purposes. General partnerships, limited partnerships, LLCs, LLPs, etc. Anything that is filing a partnership income tax return. So you hear me say partnership, I mean all those things. So we're talking about income that passes through those entities, partnerships, S corporations. Also, it applies to wholly owned businesses. So you report income on a Schedule C, Schedule F. This can apply to you as well. So up to 20% of that qualifying income. There are a number of rules on what qualifying income is and is not. And I will tell you that it's not terribly well defined right now. It is so poorly defined. I'm going to show this to you like you can actually see it. I have a copy of a letter that the AICPA sent to Treasury and the IRS yesterday, literally dated January 29th, asking for additional guidance on what these rules mean in terms of what's service income, how do you define income for purposes of what's qualified. So we can talk to you about what we think this law means, what we think is going to happen with it. I think we got a pretty good idea, but there are going to be changes. There may even be technical corrections that Congress will revisit. There are going to be regulations issued. There's going to be additional guidance from the IRS to help us better define these terms. So here's what we know now. There are limitations that apply to this income. There are complex formulas that you have to apply. They are based on wages. They are based on capital investment. There are triggers in terms of taxable income, or I should say more correctly, there are taxable income numbers under which you don't have to worry about those limitations. That taxable income number for a taxpayer that is married filing jointly is $315,000. So if you're below that number in taxable income, not the pass-through income that we're talking about, the qualified business income, taxable income on your Form 1040. If it's below 315, you don't care about any of the limits I'm talking about. If it's over 315, you start to care. And there's some phase-in rules there. I won't go into them. It's just algebra, and nobody wants to talk about algebra. I know some of you might, but I mean, you all came willingly to a tax seminar, so maybe some of you did. We filled up a room, and I think we were pretty open on the invitation, what this was about. So you have no one but yourselves to blame. What's not included? What sort of income is excluded from getting this pass-through deduction? What I do for a living. It's a service business. I'm a CPA. Attorneys. Healthcare professionals. Performing artists. Got any mimes in the room? I wouldn't admit it either. You are excluded from getting this deduction. However, just like the wage limitations I mentioned, there are some taxable income triggers. If you are under those numbers, then you're okay. So if you are a lawyer whose taxable income is under $315,000 a year, you're married filing jointly, you can get the pass-through deduction, at least as the law is currently written. So what I want to do now is take a look at this. And I know most of you can't see these numbers. This is a stripped down, oversimplified, not even working anymore picture of a model that we are using to work with a number of clients to basically analyze, should I be a shoe, a thimble, or a top hat? You can see, and I'm not going to move around because I was told not to, and you can't see it, but there's a little electric fence around me, and I'll get shocked if I move too much. If you look at the old law, which is those first two columns, that first little box, there's a difference in the effective tax rate between a pass-through entity, a partnership or an S corp, and a C corporation. There's an effective rate difference of not quite 11%. And that's because an individual is going to pay at a top rate of 39.6, and a corporation, we said, well, they pay it, let's say they pay at 35%, even though they quite likely would have some tax at a lower rate, but it'd be up to 35%. Plus, there's the additional tax on the dividend to the individual when their earnings are pulled out. So you end up with an effective rate of around 50% for a C Corp under old law. Same scenario under new law for a C Corp. Wow, because of the tax rate drop, that's actually around 40% now. Okay? If you don't have the pass-through deduction that I've been talking about, the rate for an individual working through a pass-through entity will drop from 39.6 to 37%, right? You heard us talking earlier about the drop in the individual tax rate. What that means is the gap between a C Corp and a partnership or an S Corporation shrinks significantly. However, if you can get all of that pass-through deduction because you don't trip the limits, you're not one of those terrible service organizations that didn't have a very good lobby when this thing went through Congress. I mean, I blame the AICPA. I do. That rate for an individual drops magically by exactly 10% from what it was under the old law. So it keeps parity between new law and old law partnership C Corp if you get the full pass-through deduction. So that 20% pass-through is the Trojan horse to treat a pass-through the same as we're going to treat a C Corporation or give them the same proportionate break. And that pass-through deduction, if you heard about this when they were working on the law, the president and Senator Bob Corker, remember that name? From Tennessee, they're both real estate moguls. They were beat up quite a bit because, well, you guys just want to pass this because it's going to benefit you. Well, it is going to benefit them, but that doesn't make it a bad thing. So again, this just shows you that there's a lot of complexity here. There's a lot of stuff that you have to consider that's not even on this page in terms of reasonable salaries, in terms of state income taxes, which are ignored completely here. So this just gives you an idea of just saying, well, I like the thimble because I like thimbles, which I don't get that. It's not that simple. So we'll move on from there. Switch gears a little bit, talk about a few other changes very, very quickly. Business interest deduction limitations, I'm going to be very, very brief here. Just to let you know that there have always been deductions on the deductibility of interest. It's more strict now. There is a formula by which you can calculate the amount of interest that you can deduct in a year. Basically, the base is taxable income that is then adjusted by adding back things like depreciation and amortization. You take 30% of that number. To that, you would add your business interest income. So that helps raise your ceiling. And you also get to include floor plan financing interest. So it's not just 30% of income as I've got there, but that is a starting point. One thing I didn't mention, I deliberately put this bullet up top so you could tune out if you fall under this. There is an exemption for small taxpayers. Small taxpayer is someone with gross receipts, average 3-year gross receipts of less than $25 million. So anybody below that limit doesn't have to worry about this. Anybody above that limit needs to deal with this limitation. Disallowance is determined at the filer level. There are just rules there to determine how that is computed if you're getting those earnings through a partnership, pass through, that sort of thing. Okay? Moving on real quickly, quick laundry list of a few other things to keep in mind. Like-kind exchange treatment. Anybody in here ever trade in a car? I know you have, I have. Okay? If you trade in a car for a business, you can do a like-kind exchange, right? Basically defer the gain you may otherwise have on getting, say, a trade-in allowance of greater than your remaining basis in the vehicle. Short version is you can't do that anymore for a business. Like-kind exchanges no longer exist for personal property, vehicles, equipment, tractors, machinery in your factories. It no longer exists. They say it no longer exists because we've got some very advantageous depreciation and expensing rules now that John's going to talk more about in just a minute. But like-kind exchanges can still be done for real property, for real estate, but not for personal property. Entertainment expenses. Entertainment expenses with a business purpose. Previously, they could be deducted at 50%. No more. There is no more deduction for business entertainment. There is still, however, a deduction for business meals, and that's the difference between I'm traveling on business and I got to get a burger because it's lunchtime, and I'm taking a client out for a burger because I want to schmooze him. One's 50% deductible still, the other is not. Again, there should be more guidance coming out on that. The other thing real quickly, there are a lot of international changes that have been made. And this has to do, again, with trying to change the playing field with the U.S. versus international businesses. There are some deemed repatriation rules now. That's part of why you're seeing things like Apple bringing money back into the U.S. That's great. We're glad they're doing it. But part of the reason they're doing it is because they're going to get taxed on some of that money anyway under these new rules. There's a lot of complexity to that, but just know that a U.S. business doing business overseas, their playing field has changed significantly. So with that, I'll stop ranting. I'm going to turn it over to John McCallum, who leads our cost segregation practice and is our in-house expert on depreciation matters. John?
There's a reason they saved me for last. It's because everybody loves talking about depreciation, right? Okay. I am going to talk to you about depreciation, capitalization. There's been some changes with the new law. But I thought I might start this off by just talking about just some bare basics. Depreciation is the way we write off the cost of fixed assets over a longer period of time. So you can't, historically, if you buy a piece of machinery, rather than getting to expense that item or write it off in the year that you bought that item, you would have to depreciate it over a certain period of time, usually 5 or 7 years. And the first thing we'll talk about under this banner is Section 179. Section 179 has been around for a long time. I remember 25 years ago or so, you could take a Section 179 deduction rather than depreciating an item. You could currently expense it under 179. That limit was about $17,000, I think. That was a long time ago. Most recently, that amount was $500,000, and as late as 2017, that amount was $500,000, $500,000. That amount, that deduction was further limited if your total expenditures, your total purchases of qualified property exceeded $2 million. So, as long as you didn't place in service more than $2 million worth of property, you could write off $500,000. Well, now the Section 179 deduction goes up to $1 million, so they've doubled that, and they've raised the phase out from $2 million to $2.5 million. So now, as long as you are placing in service less than $2.5 million worth of qualified property, you can expense that currently. So that's a good thing for the taxpayer. It's a good thing if you've got a capital-intensive business. Generally, what qualifies for Section 179 is depreciable, tangible personal property. That is to say, it's machinery and equipment, those types of things. It is not real property. It's not buildings. It's not land improvements. The definition of what is qualified for 179 is also changed with the new law. So we've got a few more goodies in that way. Previously, personal property used in the hotel business was not eligible for Section 179, and that is specifically included now. And that's things like guest room furniture or these pretty fixtures in this room. Things like that are now subject to Section 179, assuming they meet all the other criteria. There's also a few other things that were added to that definition. In non-residential real estate, there are certain items of property that you see a lot of if you've got commercial real estate. You're going to make repairs and replacements of a roof, HVAC equipment, security equipment, things like that. Previously, that had to be capitalized with the cost of the building, which was a long-lived asset. And now they've included that in Section 179, so it makes it a lot easier to write those items off quickly. My next thing I want to talk about is bonus depreciation. And honestly, the changes to bonus depreciation really renders what I just said about Section 179 as kind of moot. You don't even have to worry about that now. Bonus depreciation has been around since 2001. It was part of an economic stimulus package back then. And most recently, bonus depreciation was a 50% bonus. What that meant was, similar to Section 179, you could get a current deduction, but it was only 50% of the cost of those items. That has now been increased to 100%. So it's sort of like 179 in that you get to write off the entire cost of that of the asset rather than depreciate it. What are the assets that that qualify for bonus depreciation? Typically, the definition is it's for any property that can be depreciated that their class life is less than 20 years. So what does that mean in plain English? What that means is these are the common things you might think of. Land improvements that are 15-year property. That's generally parking lots, paving, sidewalks. Anybody that has a building is going to have these things. Landscaping, that's 15-year property. Also 15-year qualified improvement property, and I'll talk a little bit more about that later. 5 or 7 year personal property. Whatever business you're in, you're going to have some type of equipment, you're going to have office furnishings, that kind of thing. So these are items that would qualify for bonus depreciation. It's worth noting here that this most everything I'm talking about starts in 2018. The bonus depreciation changes actually started for assets placed in service after September 27, 2017. So we've got a little bit of opportunity there for your 2017 taxes if it just so happens that you place some qualifying property in service in the last quarter of the last year. We can't plan for that, it just is. It's also worth noting that 100% depreciation, bonus depreciation, goes through 2022. After 2022, that percentage decreases 20% per year thereafter. Also, since 2001, we've had bonus depreciation, but it's not as generous as it is now in terms of the percentage, but it was also limited to new property. So if you went out and bought a used piece of equipment, you were not able to take bonus depreciation on that equipment. Under the new law, bonus depreciation applies to new or used property. So that greatly expands the application of bonus depreciation. Now, something to think about here is how does this apply in a real estate transaction? And if you're thinking about this, I just told you that this applies to these shorter-lived assets. So how does it apply to real estate? Well, if you buy a building, you are going to also buy everything that's in that building. You're going to buy a lot of fixtures that are in that building, and you're going to buy a parking lot and some landscaping and all those types of things. All of those things are shorter-lived property that can be written off over a shorter period of time, and with this new law can be written off entirely using 100% bonus depreciation. The only way you can quantify those assets, however, is to do a cost segregation study, which is something that I do. Just say it. The next thing I'm going to talk about is qualified improvement property. The new law establishes this as a new category of an asset. The cost recovery period for most items of real property, buildings, is generally 39 years. That's for non-residential property. All of these buildings up and down Highland Colony, they're being depreciated over 39 years. Well, this is a special category of real property called qualified improvement property. The recovery period on these assets is 15 years. So if you can fit them into that category, that's what you want to do. Qualified improvement property defined is improvements to the interior of a building of a non-residential property placed in service after the date the underlying building was placed in service, the underlying structure. It does not include elevators, escalators, or internal structural framework of the building. So, what does that mean? If you have a multi-tenant office or a multi-tenant retail building where you are going to have this tenant finish out is going to change every time your tenants change. You're going to be replacing a lot of those interior improvements, and all of those would be subject to this treatment as qualified improvement property. And if you'll go back to that last slide, don't really go back to it, but you remember I said bonus depreciation applies to assets that were less than a 20-year depreciable life. So if it's a qualified improvement property, it is also going to be eligible for bonus depreciation. Now, I mentioned the multi-tenant office and the multi-tenant retail. There's a lot of other applications. If, for whatever business you're in, you decide to go out and buy an existing building that was previously occupied by another business, and you have to go in and totally gut the building and change it to suit your needs. All or most all of those costs that you're going to put into it to do the renovation is going to be subject to this treatment as qualified improvement property, and also subject to bonus depreciation. So just something to think about. And if you're in the situation where you are acquiring substantial fixed assets, these are the kind of things you need to talk about. You need to ask your advisor to tell you about it. We can help you with that. That's gonna end it for me. And before we leave, though, I am going to turn it back over to Bob Cunningham.
I want to tell you a little bit about GranthamPoole in case you're not familiar with our firm. We're one of the largest CPA and advisory firms in Mississippi. We have about 40 CPAs and about 75 total employees. We have an office, our primary office is here in Richardson, just across the street almost, and then we also have an office in Oxford as well. Thank you so much. We do appreciate your presence. We're through.